Hey guys, welcome back. A big story we've been hearing recently in the news is the role of the government and the impact that it should have on the economy. Now, remember, in our country, we live in this belief that we're a capitalist nation and the government shouldn't get involved in the market and the government should really stay out of the economy. Clearly, this is the furthest thing from what's actually happening. If you guys have been paying attention to the news, you're seeing that the government just injected about $2 trillion into the economy. So this really shows two things. One, the government has and does play a direct role in the economy. And two, we need to understand how and what the government does in the economy. That's going to be the purpose of our class today. So, government involvement in economics is something called monetary policy. What the government does is that it analyzes the trends of the economy and identifies if there's a need for government involvement. This would either be expanding the economy, something known as an expansionary policy, or to slow the economy down to prevent massive inflation, known as a contractionary policy. The problem we are seeing today, the government is so divided that the Republicans have their vision of what the government should be doing, just the same thing as the Democrats, and this is leading to the debate and controversy over how the government should get involved. The part of the government that makes these moves, though, is not actually Congress. They influence if there's going to be bailouts and things like that, but one part of the government that nobody knows anything about is something called the Federal Reserve. So guys, I would argue and say that the Federal Reserve, it's probably one of the most important elements in the American government system, but it's definitely one that not a lot of people know anything about. So that's what we're going to do for the next couple of minutes. So what the Federal Reserve is, it's a series of national banks that work hand in hand with each other, watching over the economy and deciding what, if any, action needs to be taken place to help aid the economy. So, a unique characteristic of the Federal Reserve is that this is not an elected position, it's appointed. As the slide says, this is done because the Fed has to make some really unpopular decisions at times in regards to maintaining the strength of the country's economy, which at times they may have to do things that people don't like. And unlike elected officials who always have to worry about getting elected, the Fed can do these unpopular moves and not have to worry about their job being in jeopardy. So with these slides, you can see what the Federal Reserve actually does. In the simplest terms, it functions as any other bank. It's just the highest bank in the United States. So how does the Federal Reserve, the government itself, speed up or slow down the economy? And the answer, it's all about interest rates, tax credits, and subsidies. So guys, when the economy is in a recession, which we're currently in right now, the government needs to speed up the economy. Well, and if you look historically, at least in the last 25 years, um, I look at the three big recessions. Okay, in 2001, the United States went into a recession because of 9/11. In 2009, the United States went into recession because of the housing bubble and bank failures. And in 2020, COVID-19 is really putting the United States into a recession. We may not be there yet, but most indications show that that's where we're going. So the government needs to step in really to take care of the citizens. If you think about it, you're going to look at unemployment, you're going to look at starvation. Like, how do people take care of their bills and survive if they can't go to work? So that's really where we're going to see the government step in and begin to create policy to try to get the economy going again to bring us out of this recession. Now, obviously, right now, today, we're kind of handcuffed because the unpredictability of COVID-19. But the hope is that when this pandemic has subsided, the United States economy is going to be ready to get going right away. And that's something that the federal government and the Federal Reserve are really focused on being in that position to accomplish. So the Federal Reserve has three tools at their disposal. in order to either slow down or increase the economy. One is the reserve requirement. So the reserve requirement states how much money a bank needs to have in reserves at a given time. Now remember, banks control the flow of money. So when you're thinking about your student loans, you're thinking about buying a car, you're thinking about taking out a mortgage, any of these things, you're going to the banks to get that money. So if we think about it, if the reserve increases the reserve requirement, that will limit the amount of money that can be loaned out. So at this point, we will call that a contractionary policy. The Federal Reserve is trying to limit the amount of money in the economy, so they are attempting to slow down the rapid growth, most likely because of inflation. So if they increase the amount of money that banks need to keep within its walls, that's less money that can be loaned out. So an example of why this is a problem. In Western New York, the housing market has had tremendous growth over the last 10 years. We've seen prices of homes double, triple, quadruple. And this is really great for people selling their houses, but for people buying at this time, the inflation is putting them in a position where they really can't afford to purchase homes. So as you can see in the scenario I described on the slide, if you reduce the availability of money, if there is too much growth, you need to calm the economy down. And you can do that by increasing the reserve requirement. Now, just the same, if we want to speed up the economy, what you would do is reduce the reserve requirement. And this makes money more accessible with the hopes of getting more money into the hands of more people, which means that there will be more money spent in the hopes of jump-starting the economy. So guys, it's really important to understand this point as we continue to go through this monetary policy. When the economy is in a recession, the market needs people to spend money. Putting your money away and keeping it might make sense to you, but in the larger economic vision, it's actually going to be the worst thing that could happen. So what the market wants you to do is start spending money. The more money in the market means that there's going to be more money in the circular flow, which means people are going to get jobs quicker, stock prices are going to increase, and the economy can recover. That's what they're hoping by giving every American this $1,200 stimulus check is either one, it's going to help to cover bills, or two, people are going to spend this. And by spending this money, it's going to hopefully get people back working again and get the economy running. So the next tool available for the Federal Reserve is increasing or decreasing interest rates. So what we're going to do is use two examples to make sense of this. So in short, when you want people to spend more money, what you want to do is decrease the interest rates, like we currently have right now. The Federal Reserve wants to get the economy going, despite the economic hardship COVID-19 is putting on the economy right now. So the Fed has reduced interest rates to historically low numbers, hoping that because the interest rates are so low, it's going to get people to want to go buy things. For example, guys, to be honest, like right now, the best time for me to go buy a house is right now. The interest rates are the lowest that they've ever been. Now, of course, I'm handcuffed because we are socially quarantined. But if the interest rates stay that low, it's the best time to go buy a new house. Or maybe for you, if you wanted to go buy that car that you were hoping for, the interest rates right now are the lowest that they can possibly be because they want people to go out and buy things. The only problem is that people are so worried about purchasing right now in this environment, they're just not wanting to. They're saving their money. So the opposite to that is if you wanted to stop spending, what you're going to do is increase the interest rates. You want to make the products more expensive to buy, which will reduce the number of people buying the product, which will create a surplus that will then lead to a reduction in price again, curbing inflation, and creating steadier price points that Americans can afford, rather than having to contend with the ridiculously high prices that low interest rates and inflation could happen. So that's really the only reason why we'd ever see an increase in interest rates, is just that prices have gotten out of hand and they want to try to, bring the prices back down to an equilibrium point that makes sense for what the market should be. So open market operations deal with buying and selling government bonds. So essentially what a bond is, it's a monetary promise from the government. When the government starts selling bonds, they want to take money out of the economy and slow down spending. Um, a lot of people don't know things about bonds anymore. When I was a little kid, my grandparents would give me a savings bond for every Christmas or every birthday. Um, and the way that the savings bond would work is that it was worth $100. But when they gave it to me when I was 5 years old, it was only worth $10. I needed to wait until I was 18 in order to cash in that bond at the appreciated value of $100. So by forcing me to wait 16 years or so to cash that bond, what that did is essentially take money out of circulation. Now, the opposite to that would be the government could decide to buy bonds back quicker and reduce the waiting period. So instead of needing to wait until I was 18 or 21 to cash in the bond, they may reduce the period to only 5 years or 10 years, because they want money in the hands of Americans. Because, of course, when we have money in our hands, we're going to spend it. So, again, spending money is a good thing when you're trying to get the economy going. So these two slides are just nice summaries of what happens in either situation, expansionary or contractionary. But this is important to remember. Our economy is a roller coaster. There are peaks and valleys, and often we are either climbing out of the valley or plunging into the valley. That is why we see the government get involved in the economy. When we are in that valley, the government's going to help to try to get us out by reducing interest rates and reducing the reserve requirements. And when we're reaching the peak or sitting on top of the peak, the government's going to create policy to make sure that we remain there. And that oftentimes looks contractionary, but they're doing that to make sure that the growth that we're seeing stays within reason, because if growth accelerates too quickly, you're going to see a huge gap between the rich and the poor. All right, guys, so that wraps up monetary policy. What I'm going to do is you're going to have a couple of just short answer questions and an RAO this week to do. So hopefully it's a little bit of an easier workload for you guys. All right, stay safe, stay healthy, and hopefully I'll see you guys in a couple of weeks. All the best, Mr. D.